Hello, and welcome to the special edition of CBTV. I'm Matthew J. Reddick, the host of Checks and Balances TV. Today, I'll be presenting the newest installment in our Truth About series, The Truth About Wall Street. By the way, you can download our free report on The Truth About Wall Street in the download section of our website. The truth, as they say, is sometimes stranger than fiction. I would venture to guess that what you're about to hear today will seem so completely strange to you, you'll be tempted to wonder if it's true. I can assure you it is. Let's talk about the early days of Wall Street. The stock market began with a few gentlemen standing by a buttonwood tree located at 68 Wall Street in New York City, trading stocks amongst each other. At that time, Wall Street was simply a path that merchants walked to and from their shops. On May 17, 1792, a group of 24 of these merchants signed what was called the Buttonwood Agreement that formalized their trading of stocks. In the early days, it cost a mere $25 to buy a seat on the exchange. By 2005, a seat on the New York Stock Exchange would run you $3.25 million. My, how times have changed. Fast forward from the late 1700s to the roaring 1920s. By then, the stock market had grown tremendously, and there was, as former Fed Chairman Alan Greenspan would later say, irrational exuberance, which means in plain English, people were buying and selling stocks with no thought of proper valuations or common sense. During this time, the stock market was completely unregulated. If you were a fairly smart individual back then, there were multiple ways to manipulate the system, and there were plenty of smart people back then who did. In April of 2010, Fortune magazine ran a story about Joseph P. Kennedy Sr., the patriarch of the Kennedy clan. Joe Kennedy was heavily involved in the roaring 20s stock market and engaged in activities that today would be called insider trading and market manipulation. As a matter of fact, when Martha Stewart went to jail for trading or taking a trading tip from her stockbroker, that was truly small potatoes compared to the crooked dealings of the Kennedys and other early stock market manipulators. As a matter of fact, here's what Fortune magazine wrote on April 10th. To an extent scarcely imaginable in a day of regulated underwriting and policy markets, Wall Street at the beginning of the bull market of the 1920s was a trackless wasteland where the unwary had no business. It was the closed preserve of insiders, tipsters, and manipulators, ruled by intense men like Joseph P. Kennedy. He became adept at the manipulative technique known as the stock pool. With a few others, he would take options on 100,000 shares as an example of an idle stock at a price of, say, $20 a share. The pool would advertise the stock by trading shares back and forth across the tape until outsiders, seeing this activity, leaped at a seemingly good thing. At the likely top, perhaps $30, $50, even higher, the pool would then pull the plug, selling the gullible public all it wanted of the overvalued stock and pocketing the profits. A refinement of this strategy added the step and profits of short selling the stock on the way down. Again, you can download our free report, The Truth About Wall Street, in the download section of our website. So, is Wall Street a safe place to invest in today? Well, if you think that the new rules and regulations put in place by the SEC have made Wall Street a safe place to invest in now, think again. Business Week magazine has reported extensively on the infiltration of the small cap stock market by both the Italian and Russian mafias. The Italian mafia has been widely reported and indicted on charges of manipulating the small stock marketplace known as the Pink Sheets. The Pink Sheets are a printed listing of tiny public companies too small to qualify to be traded on a stock exchange, but can be accessed electronically today. More recently, the New York Daily News reported, over the years, Wall Street has seen its share of miscreants, from Jay Gould to Bernie Madoff. During the high-tech bubble of the late 1990s, New York's 5 mafia families realized they could steal just as easily from investors as they could from the karting industry or the Fulton fish market. Utilizing a time-honored pump-and-dump scam, the mob came to Wall Street and walked away with tens of millions of dollars. Pump and dump, by the way, is where a firm buys a sleepy stock and then pumps it or promotes it to retail investors, driving the price up. After the stock has risen sufficiently, due only to a rise in trading volume and sudden buying interest, they then sell the stock and get out with big profits before those who bought it know they are left holding the bag with, once again, worthless stock. You would think, or at least hope, that with all of the new government rules and regulations today, that by now it would be hard to pull off any shady dealings that would cause the public to lose money. Unfortunately, you don't have to look long or hard to find dozens of cases that prove that even today, the retail investor has the deck stacked more against him or her than the odds at a Las Vegas casino. As an example, the big case in the news and on television recently was the Goldman Sachs deal that found the executives called before Congress in 2010. To make a complicated deal simple to understand, here's what Goldman did. Along with a partner, they picked a list of mortgage-backed securities, basically groups of mortgages pooled together and sold them as a unit, and put them together into an investment pool. They then marketed and sold that pool to institutional investors. But at the same time they were promoting the pool, they were also betting that it would lose money. You heard me right, lose money. In fact, they invested a lot of money so it would pay off big time if the pool did in fact lose money. Now let me ask you a question. If you got to pick the type of assets that went into an investment fund which you thought could lose money, would you put in really good assets or a bunch of lousy assets into the pool? Well, that's what Goldman did. They filled the pool with, and I quote from what has been widely reported from emails between Goldman Sachs employees, crap. They then sold this crap to other unwitting investors who naively thought that Goldman Sachs, a prestigious and highly respected Wall Street firm, was acting in good faith. Well, when the pool eventually did fall apart in what we now know as the mortgage crisis, investors lost billions of dollars, while Goldman and their partner made billions. Goldman was eventually fined about $500 million for this losing investment deal by the SEC, but they got to keep the rest of their profits. Talk about the perfect crime. And as a final comment on the devious practices of Wall Street, in his book, The Lies About Wall Street, financial planner Ric Edelman devotes an entire chapter, 43 pages, documenting the fines and problems that big financial firms have been assessed recently. And I don't mean 43 pages of prose. I mean 43 pages where each entry is another investment firm that was fined. In all, Edelman documents nearly 1,000 cases where financial firms have been fined for acting against the best interest of the public. My, oh my, what a shame it is. And remember now, you can download our free report, The Truth About Wall Street, in the download section of our website. So, what's an investor to do today? If the deck is so stacked against you, what should you do? What can you do, and who can you believe in and trust? First and foremost, you need to be careful. Do your own research instead of accepting at face value what's out there in the press or in advertisements. Even the supposedly altruistic AARP has been widely reported and investigated by Congress, not much more than the largest insurance agency in the country. You simply can't believe any advertising at face value anymore. It's really not safe out there, and no one else is as interested in protecting your assets and your money as you are. So be cautious and careful with whom you trust with your financial nest egg. It may have taken you a lifetime to accumulate, and if you're not careful, it could disappear in an instant. So in conclusion, if you're going to purchase any type of stock, bond, mutual fund, or any securities product at all, consider working with a competent professional financial advisor who can help you navigate through all of the different products and variations out there in the marketplace today. Also, be sure to request our free report, The Truth About Wall Street, by logging onto our website and downloading this in-depth report. We want to arm you with the truth about how Wall Street really works, so you'll have a better chance at making money instead of losing money. And revisit the download section of our website often for additional information and other Truth About reports on many other popular investment products available today. As a quick reminder, be sure to watch a new edition of Checks and Balances TV every week at checksandbalances.tv. Until then, dump debt, invest wisely, believe in yourself, and make it happen.